According to a story posted on The Atlantic, an anonymous Maryland-based information technology specialist started researching Bitcoin with heightened passion a few years ago. He saw the lofty objective of blockchains and Bitcoin's distributed transaction ledger. Watching the astonishing rally and the value of Bitcoin and other cryptocurrencies, he said, "I want to see how far it would go." He invested $1,000, but shortly after, the crypto markets began to falter. He began to lose money and decided to pull out. This specialist is one of the thousands of American investors who have seen their savings disappear, and most time the problems can be traced to their crypto portfolios. "A lot of us feel cheated," was the devastating claim of the construction site manager from California, who was woken up by a message about the FTX crash in the early hours on November 8, 2022. I and many others, we got caught up in some kind of intense euphoria last year about the small guy's chance of going to zero to hero, and this is now the morning after. The hardest thing about this loss is that we didn't get a chance to lose the money ourselves. It was just taken from us, he said. "I was very stressed and I couldn't sleep." This statement was from a tech worker who reckoned that it would take him about 20 years to save the amount that he lost in the FTX collapse. He explained that he lost some money trading in 2018, but it pales in comparison from the losses from the FTX crash. He had hoped to use the funds for a deposit on a house and had identified crypto as a backup during turbulent financial times. But the money was gone. All of it. Of the various reports and updates containing the stories of agitated crypto investors who have lost their investments in one way or another, the FTX saga last year seems to be the most horrendous. The internet abounds with tales of overnight crypto millionaires, but according to an estimate, more than half of Bitcoin investors have lost money trading the cryptocurrency. Sometime in the past, the early Bitcoin investors saw their investments balloon into millions or even billions of dollars after buying in for just pennies. However, with Bitcoin fast becoming a mainstream asset, those easy money days have faded into thin air. At one point, Bitcoin's price hovered around the low $40,000, which was several times more than what it was in 2020. But what's the problem with that? Well, thousands of investors jumped in immediately, definitely intrigued by the hype. According to reports, economists noted that risk-seeking young men are the main segment of new Bitcoin investors. The interesting fact is that this category of Bitcoin investors is not engaged in the idea of crypto because of any high-profile objectives of decentralized finance, but are excited by the promises of big returns. And here's a little secret. The so-called crypto whales, or even humpbacks, tend to sell during periods of price increases. Smaller investors flooding into the market are only fodder for the real Bitcoin bulls to sell their stock, allowing early investors to cash out at their expense. Plus, crypto exchanges have pushed the narrative that users need to get in fast because crypto is considered the future. This was especially the case back in 2021 when the price of crypto was mounting rapidly. Big name actors and entertainers were pushing people to invest. For example, the Crypto.com Super Bowl ad had the tagline, "Fortune favors the brave." Another example was the FTX ad featuring Larry David, establishing the case that you don't want to miss out on the future of DeFi. Alas, the exchange blew up, tearing hearts apart. It can be tempting to go all in on a crypto asset that offers an attractive upside potential, but investors should remember that this space is highly speculative. Many cryptocurrencies do not offer any long-term utility. Most investors simply buy tokens with the perspective of making short-term gains. Of course, this strategy can work for some investors, but most will end up burning through their capital in the long term. Many high-trending crypto assets have since dropped more than 90% from the all-time highs that were achieved during the most recent bull market. Whether or not these cryptocurrencies will survive or recover in the future remains to be seen. Despite the highs and lows, cryptocurrencies still carry the common message: detachment from banking systems. Although cryptocurrency is a different type of asset than other investments, the traditional investing rules are still relevant. This includes the essence of diversification so that one can create a well-balanced crypto portfolio. For investors inclined to the stock market, crypto diversification presents new challenges. The risk and volatility of the crypto market make it difficult to find solid investments, as there are no index funds that provide one to a large group of cryptocurrencies. A well-balanced crypto portfolio contains multiple types of cryptocurrencies with different use cases and risk levels. A significant part of a well-balanced crypto portfolio is maintaining the balance between crypto portfolio and overall investment portfolio. Cryptocurrency is a high-risk investment, so it should only make up a small portion of your total investments. And here is a solid rule of thumb. Limit crypto between 5 to 10% of your overall portfolio at most. Creating a diversified portfolio is crucial given how volatile and speculative the trading industry is. In this regard, a well-diversified portfolio should contain a wide variety of crypto assets across different niche markets. Holding a diversified portfolio of cryptocurrencies will ensure that investors avoid becoming exposed to a small number of coins. This implies that if one project does not perform as expected, other coins within the diversified portfolios could help cover the losses. So the purpose of the crypto portfolio allocation is to spread the risk across as many projects as possible. However, investors must ensure that their portfolio allocates funds to establish large cap cryptocurrencies. So far, Bitcoin and Ethereum represent good alternatives here. Investors might also wish to allocate funds to newly launched projects with smaller market capitalizations. This offers investors the opportunity to target higher gains, but extreme care needs to be taken as a result. Bitcoin is the largest and most valuable crypto asset in the industry. Although Bitcoin will ultimately grow at a slower pace in comparison to the best altcoins in the market, it offers some much needed portfolio long-term stability. The cryptocurrency hit an all-time high over $68,000 in November of 2021, and it was worth more than $1 trillion. Bitcoin's valuation has since declined by 70% from its previous peak, but this offers a great opportunity from a cryptocurrency asset allocation view, as Bitcoin can be purchased at a huge discount. However, rather than allocating capital to Bitcoin in a large sum, risk-averse investors might instead consider a dollar cost averaging strategy. DCA simply means buying a small amount of Bitcoin each week or month at a fixed investment stake. Behind Bitcoin, there is Ethereum. This is another crypto project to consider when evaluating the best crypto portfolio allocation strategy. Just like Bitcoin, the value of Ethereum has declined considerably since the 2021 bull market. When compared to Ethereum's all-time high of almost $5,000, the crypto asset is trading at a discount of about 70%. This also offers an attractive entry price when investing in Ethereum. There are thousands of altcoins built on top of Ethereum's blockchain, known as ERC20 tokens. This is because Ethereum is a trusted network, well known for its security and efficiency. Now that Ethereum has completed its much anticipated merge upgrade and the transition to proof of stake has been completed, their chances for efficiency are very strong. Notably, Bitcoin and Ethereum are good investment options to fit your crypto portfolio, but you can also consider the popular smart contract platform Cardano. This cryptocurrency has been touted as a third-generation cryptocurrency. With its standout features and use cases, it is an attractive option. While Ethereum might be heavily weighted, the portfolio can also allocate capital with the likes of Cardano and Solana. And there are only so much liquidity to go around, meaning that not all projects will witness notable growth, but investing in a large number of projects with a meaningful amount of capital poses the best crypto portfolio allocation strategy in the long run. Cryptocurrencies are not the only crypto investment option out there either. You can also invest in crypto stocks, which are companies related to crypto and blockchain technology. Since these companies provide a distinct type of exposure to crypto than investing in cryptocurrencies, they are great for a diversified crypto portfolio. Plus, part of the excitement of crypto investing is looking for smaller diamonds in the crypto sector. Smaller crypto projects have a much greater risk of failure, but they can also be extremely profitable if they take off. It might be seen as daunting to put together a balanced crypto portfolio, but it's simpler than it seems. With the right decisions, your portfolio will skyrocket. But it's not something that needs to happen or will happen overnight. Well, that's the end of today's video. Make sure you click the subscribe and notification buttons.